Hey everyone, I'm your host Simo here from Investment Research. Actually, there are a lot of things happening with Tesla stock today. Frankly, many financial institutions and market makers have released reports on this stock. So I've prepared some important information for you in my notes. So let me walk you through exactly what's going on, what the institutional money is doing, what Wall Street expects, and most importantly, whether you should be buying, selling, or holding at these levels. Let me start with where we are right now because the price action tells a story. We're trading at 426.06 as of midday today, down 2.62% or 11.46 from yesterday's close. Over the past 24 hours, according to some data sources, we're down 3.88%. Now, when I see that kind of move, I immediately check the volume and the context. We're trading about 13% below where we were 4 weeks ago, and we're down significantly from the 498 at 83 52-week high we hit back in December. But here's what most people are missing. The 52-week low is $214.25, which means even after this pullback, we're still up 99% from the bottom. This stock has doubled from its lows, pulled back 15%, and now everyone's panicking 7 days before earnings. That's not analysis, that's emotion. The 52-week range is $214.25 to $498.83, which is a 133% spread. That tells you everything about the volatility in this name. If you can't handle 15-20% swings, you shouldn't be in Tesla. But if you understand how to position size properly and use options to manage risk, this volatility is exactly what creates opportunity. And right now, at 426, I think we're sitting at one of those inflection points where the smart money is making moves while retail panics. Now let me talk about what's driving the recent weakness because understanding the why is critical to making the right decision. First, we have the Q4 delivery numbers that came out on January 2nd, and they were disappointing. Tesla delivered 418,227 vehicles in Q4, down 15.6% year over year, and below the company-compiled analyst consensus of 422,850. For the full year 2025, deliveries were 636,129, down 8.6% from 1.79 million in 2024. That's the first annual decline in Tesla's history, and it spooked investors. BYD overtook Tesla as the world's largest EV seller with 2.26 million units, up 28%. That's a major competitive shift that Wall Street is struggling to price in. Second, we have the valuation concern. Tesla is currently trading at 201 times forward earnings. Let me say that again, 201 times forward earnings. The average analyst price target is 389, which represents 7% downside from current levels. Out of 51 analysts covering the stock, 30 have hold or sell ratings. That's 59% of analysts who are either neutral or bearish. Only 21 have buy ratings. This is not a loved stock on Wall Street right now, and that's creating selling pressure. Third, we have the political overhang. Elon Musk's involvement with the Trump administration, his political statements, and the perception that he's distracted from running the company are all weighing on the stock. Europe sales declined 27.8% in 2025 to 235,322 units according to data, and some of that is attributed to Musk's political activities alienating customers. In China, Tesla faces intensifying competition from domestic manufacturers, with market share eroding despite local production capabilities. These are real fundamental challenges, not just noise. Now let me walk you through the Q4 earnings setup because this is what matters for the next 7 days. Tesla reports Q4 2025 and full year results after the market close on Wednesday, January 28th, 2026, with the earnings call at 4:30 p.m. Central Time. Wall Street expects revenue contraction given the 15.6% decline in deliveries. In Q3, revenue was $28.09 billion, up from estimates of $26.54 billion. EPS in Q3 was 0 to 50, missing the 0.56 estimate, down 31% year over year. For Q4, analysts expect further EPS decline and revenue pressure. But here's what I'm watching, and this is where my analysis diverges from consensus. The energy storage division is the hidden gem that nobody's talking about. In Q3, Tesla deployed a record 12.5 gigawatt hours, up 81% year over year. This segment generated $3.4 billion in revenue with $1.1 billion in gross profit, demonstrating significantly superior profitability compared to automotive. In Q4, Tesla deployed 14.2 gigawatt, another record. For the full year, energy deployments totaled 46.7 gigawatt. This business is growing exponentially while automotive stagnates, and it's massively profitable. In Q3, despite the EPS miss and delivery concerns, Tesla generated record free cash flow of approximately $4 billion, elevating total cash and investments to over $41 billion. That's a fortress balance sheet. They're spending approximately $9 billion on capital expenditures in 2025, expected to increase substantially in 2026, primarily allocated toward AI infrastructure, including the Optimus robot program. This is a company with the financial flexibility to invest aggressively in future growth while the market obsesses about near-term automotive weakness. Now let me talk about what Wall Street is missing in their analysis, because this is where I think the opportunity lies. Analysts are valuing Tesla as an automotive company. They see declining deliveries, margin pressure from Chinese competition, and they slap a 201 forward PE on it and call it overvalued. But Tesla is not an automotive company. It's an energy company, an AI company, a robotics company, and yes, also an automotive company. The Optimus humanoid robot, which Musk called the infinite money glitch on the Q3 call, has mass production timelines pushed from early 2026 to late 2026. His compensation package mandates deploying 1 million Optimus robots. If they execute on that, this is a multi-trillion-dollar opportunity that nobody is pricing in. The full self-driving software is another massive underappreciated asset. Tesla just put FSD behind a monthly paywall, creating recurring subscription revenue. If they can scale FSD to millions of vehicles paying $99 to $190 per month, that's $1 to $2 billion in annual recurring revenue with 90% margins. The robotaxi and cybercab programs, if they launch on schedule, could completely transform the business model from selling cars to operating a mobility as a service network. That's a $10 to $20 trillion addressable market, according to some estimates. Let me give you the analyst picture, because the dispersion tells you Wall Street doesn't know how to value this company. We have 51 analysts covering Tesla. The average price target is $389, representing 7% downside. But the range is enormous. GLJ Research, the biggest Tesla bear, raised their target from $19.05 to $25.28 while maintaining a sell rating. They've been calling Tesla overvalued for years, criticizing negative delivery growth, weakening demand, and price cuts. On the bullish side, Dan Ives at Wedbush has a target well above $500, calling Tesla a leader in autonomous driving and predicting a successful 2026 if they execute on robotaxi and cybercab schedules. Cathie Wood's ARK has been selling Tesla recently, rotating into semiconductor stocks. That got massive media attention. But you know what? I don't care what Cathie Wood does. ARK's performance has been terrible. What I care about is what Fidelity, Vanguard, and State Street are doing with their index funds, because those are multi-trillion-dollar institutions that drive long-term price action. And those funds are not panic selling because they can't. They're index-weighted holders who rebalance mechanically, and Tesla remains a top 10 S&P 500 holding. Now let me address the valuation debate head on, because this is what everyone argues about. Yes, 201 times forward earnings is expensive, there's no denying that. But let me give you some context. In 2020, Tesla traded at 300 to 400 times forward earnings and went up 743% that year. In 2021, it traded at 150, 200 times forward earnings and went up another 50%. High multiples don't mean overvaluation if the growth trajectory justifies it. The question is not whether 201 times PE is high. The question is whether Tesla can grow earnings fast enough to justify that multiple. If Tesla grows EPS at 30-50% annually over the next 3 years, which is what Bull's project based on energy storage growth, FSD scaling, and Optimus deployment, then paying 201 times today for earnings 3 years from now makes sense. The stock would compound at 20-30% annually, even if the multiple compresses to 100 times forward earnings. That's the bull case. The bear case is that automotive continues declining, energy growth slows, Optimus gets delayed another year, and the multiple collapses to 50-75 times forward, putting fair value at 200 or 250. That's 50% downside from current levels. Here's how I'm thinking about risk-reward heading into earnings on January 28th. If Tesla beats on energy storage revenue and gross profit, shows automotive stabilization even if volumes are weak, provides concrete Optimus timelines for late 2026 production, and guides to 2026 capex above $12 billion, indicating aggressive AI investment, the stock rallies 15 to 25% to $490, $530. That's within striking distance of the $498.83 all-time high. If they disappoint on energy margins, automotive gross margins fall below 15%, Optimus gets pushed to 2027, and 2026 guidance is cautious. We test $383 support, which is 10% downside from here. That's the technical support level based on recent patterns and the 200-day moving average. The way I see it, the risk-reward is asymmetric to the upside. You're risking 10% to make 15-25%. That's a 2.5 to 1 ratio, which is attractive for a 7-day hold into a binary event, but only if you size the position appropriately. Don't go all in. Don't bet the farm. But a 3-5% portfolio allocation with defined risk through options makes sense to me. Now let me talk about what the options market is telling us, because this is where smart money often positions before binary events. Looking at the January 31st expiration, which is 3 days after earnings, the call to put volume ratio is skewed toward puts. That's unusual. Typically before earnings, you see call buying as traders bet on upside. The fact that put volume is elevated suggests institutions are hedging downside or betting on a miss. The implied volatility for options expiring January 31st is pricing in about a 12-15% move in either direction. That's consistent with historical earnings reactions for Tesla. If you own shares and you want to generate income while hedging some downside, you could sell the January 31st $450 call and collect about $15-20 in premium. That's 3.5 to 4.7% income in 10 days. If the stock stays below 450, you keep shares and premium. If it goes above 450, you sell at $450 and keep the premium, which from 426 is a 5.6% gain plus premium for about 10% total return. Not bad for 10 days. If you don't own shares but want exposure, you could buy the January 31st $400 put and $450 call straddle for about $55-65 total. If the stock moves more than $65 in either direction from 426 size, you profit. That means above $491 or below 361s. Based on the implied volatility pricing in 12-15%, that's a reasonable bet. If you're directionally bullish and want leverage, buy the February 7th 430 call for about $25 to $30. If the stock rallies to $480 after earnings, your call is worth $50, which is 67-100% return. But if it stays below $430, you lose 100% of premium. Only do this with 1 to 2% of your portfolio. Let me walk you through the key metrics I'm watching on January 28th, because these will determine whether this stock goes to $500 or $380. First, automotive gross margin. In Q3, it was under pressure. If it falls below 15% in Q4, that's a major red flag that competition is eating into pricing power. If it holds above 17%, that's bullish. Second, energy storage revenue and gross profit. This is the growth driver. If Q4 energy revenue exceeds $3.5 billion with gross margins above 30%, that validates the diversification story. Third, free cash flow. In Q3, they generated $4 billion. If Q4 is above $3.5 billion despite weak automotive volumes, that proves the business model is resilient. Fourth, 2026 guidance. This is the big one. If they guide to vehicle deliveries above 1.8 million, that implies 10% growth and would be very bullish. If they guide to flat or declining deliveries, that's bearish. Fifth, Optimus update. If they provide a concrete production timeline with customer commitments for late 2026, that's worth $50–100 billion in market cap in my view. If they're vague or push timelines further, that's bearish. Sixth, full self-driving metrics. How many subscribers? What's the attach rate? What's monthly recurring revenue? This could be a $5–10 billion annual revenue stream if it scales, and investors want proof it's scaling. Seventh, commentary on Musk's political activities. If they address the Europe sales decline and provide a plan to rebuild brand perception, that's constructive. If they ignore it or downplay it, investors will assume the problem persists. Eighth, China competitive positioning. Are they gaining or losing share? What's the strategy against BYD, NIO, and Xpeng? This is 30% of their business and they're getting crushed there. Ninth, Cybertruck ramp. After boasting about 1 million reservations, deliveries have been a trickle. Is production scaling in 2026 or is this a flop? Now let me give you my personal view on what to do at these levels, because this is what you're really asking me. At $426, you're buying 14.6% below the 52-week high of $498.83 and 99% above the 52-week low of $214.35. You're buying 7 days before a major catalyst that could move the stock 15% in either direction. You're buying a company with $41 billion in cash, generating $4 billion in quarterly free cash flow, growing energy storage at 81% year over year, developing Optimus robots that could be $1 trillion business, and trading at 201 times forward earnings, which is either cheap or expensive depending on whether you believe the growth story. If you don't own Tesla and you're considering buying, I would not go all in at one price. Start with 25% of your intended position at 426. If it drops to 400, now 410 before earnings, add another 25%. If it drops to $380, $390, add another 25%. Keep the final 25% in reserve. This way, you're scaling in over a range rather than betting everything on one price level. If you already own Tesla from lower prices, say you bought at $250, $300, you're up 40 to 70%. I would hold through earnings. Don't sell before a catalyst unless you need the money for something else. The institutions with $41 billion in cash on the balance sheet are not panicking, and neither should you. If you bought at $450, $490 and you're underwater, you have two choices. Average down at 426 OX or below to lower your cost basis, or hold and wait for the recovery. Don't panic sell at 426 after buying at $470. That's the worst possible decision. You're locking in a 9% loss right before a catalyst that could take you back to break even or better. The only reason to sell is if you think the company is fundamentally broken, which I don't believe. I think they have execution challenges, but the assets and cash position are intact. Now let me talk about the macro context, because this matters for Tesla more than most stocks. Elon Musk's political involvement with the Trump administration is a double-edged sword. On one hand, Trump ended the federal EV tax credit early, pulling demand forward to Q3 2025 and hurting Q4 and 2026 sales. That's a direct negative impact from policy. On the other hand, Musk's proximity to Trump could lead to favorable regulatory treatment for FSD, Robotaxi, and Optimus. If Tesla gets permission to deploy driverless taxis in major cities ahead of competitors, that's worth hundreds of billions in market cap. So the political overhang cuts both ways. The European sales decline of 27.8% is a problem, but it's also an opportunity. If Musk steps back from politics or Tesla launches a marketing campaign to rebuild brand perception in Europe, sales could recover quickly. The product is still best in class. The supercharger network is unmatched. The issue is brand damage from Musk's statements, which is fixable. In China, the competition from BYD is intense, but Tesla still has advantages in software, battery technology, and manufacturing efficiency. They just need to price competitively and launch new models tailored to Chinese preferences. That's doable. Let me close with this because I want to make sure you understand the big picture. Tesla is at a crossroads. The automotive business is facing headwinds from competition, Musk distraction, and policy changes. But the energy storage business is exploding. The AI and robotics opportunity with Optimus is enormous. The FSD software could become a multi-billion-dollar recurring revenue stream. The robotaxi and cybercab could transform the business model. The question is not whether Tesla is a good company. The question is whether the market is correctly pricing in all these moving parts at 201 times forward earnings. In my view, the market is underpricing the upside optionality from energy, Optimus, and FSD while overweighting the downside from automotive. That's why I think 426 7 days before earnings represents compelling risk reward. You're not buying at the bottom, but you're not buying at the top either. You're buying at a level where if they execute on even 2 of the 3 big opportunities, energy, Optimus, or FSD, the stock is materially higher 12 months from now. And if they stumble, you have a company with $41 billion in cash that can weather the storm and try again. My rating is cautiously bullish. Conviction level 7 out of 10. I would buy 25-50% of my intended position at 426, scale in on weakness to $380-400, and hold through earnings on January 28th. Use options to hedge downside if you're nervous, but don't sit on the sidelines entirely. This is one of those moments where doing nothing is the riskiest decision. 7 days from now, we'll know a lot more about whether Tesla is a $600 stock in 2026 or a $300 stock. Position yourself accordingly, but position yourself. Don't let fear keep you out of what could be a generational opportunity. Thanks for your time today. I'll be back on January 28th after earnings to break down the results and update my thesis. Stay disciplined, manage your risk, and remember that the best opportunities often come when everyone else is scared. That's exactly where we are right now with Tesla.